I'm John Weber with AM Best. Cyber insurance market, stress testing the future. We'll be examining a new report that brought together teams from AM Best and Science to examine the state of cybersecurity coverage, risk modeling, and the possible impact of cyber shocks. We're going to meet our panelists in just a minute. Now, we may mention the subject of financial strength ratings. A full explanation of AM Best ratings is available online at ambest.com/terms. The opinions expressed by the panelists are theirs and theirs alone, and do not necessarily reflect the opinions of AM Best. Now let's meet our panelists. We have with us today Fred Aslami. Fred is an associate director with AM Best. Fred, good to see you.
Good to see you, John. Happy to be here.
Also, we have Sridhar Manian. Sridhar is a director with AM Best. Sridhar, welcome.
Thank you, John.
And last but not least, Scott Hamasfar. Scott is product marketing manager with Science. Scott, welcome.
Thank you. Pleasure to be here, John.
And Sridhar, let's start with you. The report states that cyber risk differs from many other insurance risks. In what ways?
Yeah, you're absolutely right, John. Cyber risk is a pretty unique risk. In the first place, it is omnipresent. It affects every single organization, and there's really no escaping it. The only thing that would differ is the extent of impact that an organization faces depending on its cybersecurity posture. And the next way it is different is it's got both the idiosyncratic component and a systematic component. The idiosyncratic component one can manage just like one manages credit risk, by diversification, by having a set of risk limits and reinsurance, etc. But the systematic component is very difficult to manage. If you take, for example, a risk like catastrophe, a hurricane has a certain geographic boundary. But cyber, on the other hand, because of the enhanced interconnectedness of today's organizational structures, it knows no bounds. There's no geographic bounds, there's no organizational bounds, and it is pervasive. So addressing this risk really requires the insurers to make sure that the underwriters, claims management professionals, the management, the board, everybody is involved in trying to make sure that they build a strategy around this risk. And of course, there's this huge talent gap because it's a new risk that we are underwriting. The cyber risk itself is a new manifestation because of the evolution of technology. So addressing the talent gap is also a critical component of managing this risk.
Scott, can you talk to us about the aggregation risks of cyber?
Absolutely. So, Science was really founded several years ago on the premise of how to help model cyber risk. And understanding, I'll start by saying if you look at the newspapers every day, there's a flood of different incidents that you're seeing coming in that have a cyber component relating to them. But as we began to index and look at these risks, we found that there were really just a handful of underlying accumulation paths that drove most of the end resulting losses that people were seeing in the news. So in today's report, we focused on two such matters. Service providers that are shared service providers that can, if they have a breach or an interruption, can have an impact on those businesses, as well as software vulnerabilities, which is an omnipresent risk that faces companies today. So those are just handfuls of, there's sort of a small set of these accumulation paths, and we really focused on two for the purpose of this report.
John, to give a brief background about the report, last year Lloyd's came up with two reports, one with Science, one with AIR Worldwide, in which they, under the two scenarios that Scott referred, they were calculating the potential losses, the economic losses on any major cyber attack under those two scenarios. And they came up with the anywhere from 4 billion to 53 billion range, and from that they took an insurance penetration risk for the cyber, and they came up with anywhere from 700 million to 8 billion in total insured losses. What the industry lacked was that specific insurance company focused exposure and aggregation analysis that we undertook in this report. So what we have done was that we took the 2016 NAIC supplemental filings that U.S. Companies provided to NAIC, and based on that projected the numbers to both the premium writings and the surplus increases to 2022. And based on those numbers, we ran the two scenarios that Scott referred to, and based on that, we'll talk about the aggregation and the results later.
So how are insurers assuming cyber risk?
Well, they're taking, it's a relatively new line, although, some companies, the larger ones, have taken it for the past 20 years. They're assuming it based on first party and second party, based on the information, again, in the NAIC. It's based on claims made and occurrence, and they provide first party and third party coverage in those policies that they issue.
Now, Fred, we're hearing a term called silent cyber losses. Can you talk to us about that, what that is, and how do they play into catastrophe loss scenarios?
Yeah, it's silent cyber is a bit of an enigma in terms of modeling, because it's really difficult to model it. What it basically is, it's a non-affirmative cyber, which refers to the potential cyber exposures that other lines of business, property, other liabilities, may carry. And also, it's relevant to the contingent business interruption exposure that one manufacturer or one policy holder may suffer as a result of failure in another vendor or a third-party related entity. So those are the losses that are difficult to measure. There are a number of court cases ongoing that they're still going through the court system here. The point is that typically as the issuance go with the cyber is that either they do it standalone or as packaged or endorsement to an existing line of business, property or other liabilities. We have always maintained that standalone, since it is a defined coverage, it's easier to manage in terms of expenses, litigation, and what have you. So, we have numbers to show actually that, if you write standalones, your loss ratios, your other ratios are lower than other if it's a packaged with other lines of business. So that's why silent is an enigma, because you cannot really create or input the modeling and come up with a number so that you can decide where it's going with the silent.
Yeah, I think that's right. Silent cyber losses aren't explicitly included in the quantitative analysis that we conducted for this study. They're discussed in a subjective way because these silent cyber events, these events that are going to cause losses that affect non-cyber liability policies, are going to be the same kinds of scenarios that would cause insured loss on a cyber liability policy. So the classic example of that was the Eternal Blue vulnerability, which came out a couple of years back, was leveraged in the WannaCry attack, which would clearly be a business interruption. It's a ransomware attack brought against companies globally, especially in the healthcare sector. That was an attack that had kind of an off switch that was found before the U.S. business hours started the following week. So we had a bit of a lucky, there's sort of a counterfactual there to think about. But then you think several weeks later, someone takes these vulnerabilities, thinks about them more deeply, and creates a stronger attack called NotPetya, which didn't affect thousands of companies, but it affected tens of companies in a very profound way. And the insurance industry, I think, found itself surprised looking at property liability programs that had significant limits. And we mentioned cyber liability. One way to manage the exposure is to maintain low limits on a per policy basis, as well as maintaining managing your book's exposure on an aggregate basis, just in pure how much limits have been offered. But property liability programs have drastically larger limits than that. So you're finding tens of losses, creating potentially billions of dollars in insured loss coming from very significant business interruption events. Those weren't quantitatively modeled in our study because both their frequency and their severity has to do with what coverage line was impacted, and their severity has to do with the actual policy language that's on the table. Every carrier has different policies in place. Those carriers might have different philosophies around how they endorse their policies and do manuscript changes to that language. And as a result of that, there's no set of assumptions that we're comfortable making to infer what losses would look like on a vast array of policies that the insurance industry has offered. But we do want to shed light on the accumulation paths because they're the very same accumulation paths that could cause those losses.
I think the loss creep that's coming out of these silent cyber losses, so for example, the ransomware attacks that Scott mentioned, that could actually, even though it's a cyber attack, it could be a loss creep in a kidnap and ransom policy that's underwritten by somebody else, some insurer. So I think those are some of the issues that the insurance industry is dealing with so that they can have a structured approach. And that's where AM Best's approach to enterprise risk management is key, because that's where the aggregation of all these risks are measured.
So along these lines, Scott, what are some of the catastrophe scenarios that you're developing?
Yeah, so within this report, we really focused on two scenarios. They're the same scenarios that we leveraged in the Lloyd's Counting the Costs report, which came out last summer. One is a cloud service provider scenario where we see common software codes and open source code used by a number of cloud service providers having a vulnerability that causes mass interruptions across cloud service providers. In the second scenario, we take a look at a vulnerability in a common operating system. Software systems have sort of economies of scale, so you want to have the same code running in a number of computers, and it's sort of the foundation of how a lot of computational technology works today, that everyone's running the very same code on all of their machines. That has significant benefits to our economy that we capture every day, and we see in how our lives are changing with technology, but it also introduces the risk of contagion vulnerabilities where every time there's an article in the news about the WannaCry vulnerability, for example, it's one or a small set of vulnerabilities that once disclosed has the potential to affect thousands of companies globally.
Yeah, to just clarify, the approach that we took was that, as I mentioned, we took the premium levels from 2016 and projected to 2022. With the losses that we came up with based on the two scenarios are gross losses. It doesn't take into account the reinsurance sessions that these companies seed out, and it doesn't take into account the potential negative impact of silent cyber. So I just wanted to make that clarification so that people understand that we're talking about gross losses and nothing about net or everything calculated in it in terms of exposure.
Sridhar, what do we know about SMEs when it comes to cyber coverage, and is it changing in any way?
Yeah, I think the small to medium enterprises that you mentioned, the cyber market in general has a pretty interesting dynamic that we observed when we've been writing these series of cyber reports. The national accounts, the Fortune hundreds, seem to be very well aware of cyber risk. The big investment banks, the big healthcare companies, they seem to be well aware of the cyber risks, and they have sophisticated risk managers working with their insurance companies and brokers, trying to make sure that they include insurance as part of a multi-pronged strategy to manage their cyber risk. And insurance companies can provide a lot of value to these clients, because I'm going back to the classic property example. When an insurance company is is insuring a commercial property, they will often come and make inspections to these properties and advise clients to add sprinklers to a certain place or fortify their windows, etc. Similarly, in the cyber risk, insurance companies, given their perspective, because they see a number of clients, they can definitely add value to these national accounts and Fortune 100 clients by advising them to, let's say, upgrade their patches more regularly or have certain kinds of virus protection systems or how to manage their operational risk. So insurance companies can definitely be a partner. The national accounts recognize that, and they seem to be embracing insurance much more proactively. The small and medium-sized enterprises, on the other hand, I think there is a little bit of sense of complacency, it appears like, because the take-up rates for small and medium-sized enterprises is less than 30% in our observation. And we think it's because they feel that the flagship companies like Target and Equifax are kind of the target breaches for the hackers, and the hackers will leave them alone. But that is, but on the other hand, the small and medium-sized enterprises might face more risks because Fortune 100 companies have very classic protocols to update their software, update their cybersecurity, etc. But the small and medium-sized enterprises may be a little bit more ad hoc than the Fortune 100 companies. So the risk is definitely there, but the adoption has been a little bit slow. But as Scott said, as more of these headline events with cyber take place, we think the take-up rate in the SME segment is definitely going to pick up. And it is a pretty reasonably sweet spot for insurance companies as well, because they can increase their diversification by increasing their exposure to a number of these SMEs. So that's the dynamic we are observing.
So I was going to say a 30% take-up rate, are we at least seeing an upward trajectory as far as that's concerned?
We expect to see a upward trajectory. It's less than 30%. I mean, some report. I mean, it's between 10 and 30%. In fact, according to some of the industry market surveys. So
especially outside of the U.S. So within most of the market surveys are within the U.S. The reporting and the data quality is much higher, but most of the market in general is actually based. It's estimated that 90% of the cyber insurance market, by gross written premiums written, is companies domiciled here in the United States. So there's a significant market opportunity, not only in addressing the small business space, where the companies can use not only the risk mitigation or the financial backstop that insurance provides, but also the policyholder services, the ability to pick up the phone, call someone who's knowledgeable to help address these situations quickly and efficiently. This is what cyber insurers have come to do over the past decade. They've got teams that are staffed to do just that, with vendors on panels that provide preferred rates. And the small and medium-sized businesses are precisely the ones that aren't prepared to handle that 1 in 100 situation that would be unforeseeable for any given SMB, but is absolutely guaranteed across a population of them. It's a significant thing in the insurance industry after looking at massive disasters to say, well, what percentage of that disaster was covered by insurance? And so there's great studies about that after Hurricane Sandy to say, I forget exactly what the number.
Around 50%.
Around 50%.
For catastrophes, around 50%
right.
Protection gap.
So,
give or take.
Yeah, so for our Lloyd's report, we looked and found it to be significantly lower than that for cyber insurance. And that's the opportunity that the market has to help provide these services to policyholders to help address before the cyber hurricane comes.
Yeah, and with regulations coming up too, there's a lot of regulations that the SEC and the NAIC and the GDPR in the US, I'm pretty sure we'll talk about them later, but all these regulations would help drive demand up as well.
Now, Sridhar, you describe expansions among industry segments that will widen the scope of cyber exposure. What is that?
I think it's essentially the same point I was trying to make earlier, which is the financial services, the healthcare sectors, and there are some sectors that intrinsically feel vulnerable to cyber and intrinsically are much more regulated in terms of reporting. But as these cyber events make headline, I'm pretty sure even sectors like nonprofit or other small to medium enterprises will definitely feel the need for cyber insurance and start getting involved in the market. So when we were projecting portfolios, we kind of tried to use some kind of heuristics like these in order to project the portfolios to 2022.
Fred, Scott was just talking about how much cyber premiums are concentrated within the U.S. market. Do you see that changing?
Well, the fact that U.S. companies are more getting insurance to cover themselves is a fact. If you go back to WannaCry, for example, WannaCry happened mostly in Eastern Europe and Asia, and it happened to the companies which were using bootlegged software, which couldn't patch. The amount of ransom that they were asking was below the insured level, insurance deductible. So it didn't have any impact there. But it caused the companies, both in Asia and other areas, to actually focus on getting more insurance. So yes, the expectation is that eventually this will increase, insurance penetration will increase to a higher level in those areas, those regions.
What are we seeing in the way of pricing when it comes to cyber?
Pricing, again, based on another report. In this report, we only focused on the market share, basically, and on the U.S. providers, NAIC filers, and projected it to 2022. But Marsh and others have reflected that the premium for the past 5 quarters, with the exception of fourth quarter 2017, have been declining. We'll have to see at the end of June, see what happens with the, with the second quarter, because there have been a couple of big cyber attacks. MyHeritage.com was hacked. 92 million users have been, violated. So, we'll have to see what the second quarter results are. But for the past few years, few quarters actually, have been declining. And even the fourth quarter 2007, there was a minor increase in the premiums.
How about as far as limits and coverages go?
Limits are all over. With the SMEs, limits, you can go from several $100 million to big national companies at, several $100 million. We have even heard that, consortiums are being formed and towers are being built to a billion level, but we haven't seen that yet. So limits are all over, and but the thing is, with companies, they have to, both the insurance company and the policyholders, they have to go through a risk assessment process to see what they need. It's not that, okay, I want to have $500 million limit and all my problems are solved. No, it's not like that. You've got to go through some risk assessment with your policyholders, see where they need the coverage and where they can improve internally to protect themselves.
All right, let's switch gears a little bit here. And Scott, can you talk about your approach to the modeling stress testing?
Yeah, absolutely. So as Fred mentioned earlier, just as a baseline, we've conducted a number of, including the Lloyd's study from last year, looking at ground-up losses, that is, the uninsured value across the economy if an incident were to happen. That's sort of the largest number that you could look at. We can then take a look at industry-level statistics for just take-up rates by certain industry sectors. What are the average policy limits that certain sectors are taking on? That'd be the insurance industry loss. This report really took it one step further to say, well, what would the loss be to any given insurer by building up a sample portfolio of what we believe their insured loss might look like. So that's if a healthcare entity had a $100 million cyber liability tower, the insured loss would be looking at that $100 million tower and what their loss was against it. Whereas here we'd be looking at, well, what if this carrier in particular were 10 million, excess of 30 million on that tower? And so we built the top 20 carriers' portfolios, modeling 2016 level data using as much public reporting as was available. And then scaled those numbers using all the, taking basically historical trends to scale them forwards to 2022 to then sort of run the counterfactual. Obviously, science loss modeling takes into account everything we know today about companies' exposure to cyber risk. So and then models what that exposure might look like over the coming 12 months. So even though we modeled 2022's losses to the industry, it's really a counterfactual because it's what would the losses look like today if we had the market, the insurance penetration rates that we expect to have in 2022. The philosophy and the approach that science takes to modeling cyber risk is to collect data at scale across a universe of companies, looking at exposure elements, not just sort of the common industry and revenue, but a number of real exposure data points to say, what does the cyber hygiene look like for a given company? Which cloud service providers do we observe that company using? And we can leverage all of that data, correlate it to past losses that have occurred, and then project what we believe those future losses to be. We do that via stochastic modeling, where we take all of the various input variables and modulate them slightly to conduct a Monte Carlo analysis that allows us to provide the reporting in this document, which provides the severity return period losses of 1 in 50 year and a 1 in 200 year loss severities, which is kind of, I'd say the emergent severity levels that are used in financial solvency in insurance and other financial use cases.
Do you see a cloud failure as being your worst nightmare?
I don't know that I see a cloud failure as a cloud failure that lasted for a significant amount of time will have a drastic impact on the economy. And that's very clear from our reporting. Obviously, the cloud service providers take this risk very seriously and take a number of mitigating steps to prevent that. But also, too, should the insureds who are relying on cloud service providers to be thinking about diversifying their usage, having backup plans, resiliency, and testing of these plans to make sure if the cloud goes down for 5 minutes or 20 minutes, you might be able to handle that. But if it goes down for 3 days, what's your plan? So as an example, many of these ransomware attacks have hit the healthcare industry. But what happens when a hospital doesn't have access to computer systems for days? They revert back to paper systems, and then they hire a lot of temps and staff. They staff up to address the fact that they can't operate as efficiently. But not all businesses can do that. And that's why we see in the shipping space, when Maersk was attacked by the NotPetya attack, that actually shut down ports globally for many days because there wasn't a robust resiliency plan for what happens if those IT systems don't operate. So certainly a cloud service provider outage of an extended period of time would be a significant event.
Can you compare it with a software vulnerability, or would that be apples and oranges?
Well, they're very different events. And what's important for insurers to think about is that the same tactics used to address the risk mitigation strategies you might use to prevent that tail risk don't work the same, because a cloud service provider vulnerability, if an outage were to happen, it might be very significant. The business interruption coverage on cyber liability policies, it covers businesses as though their building burned down on a property policy to provide that business interruption loss. So those losses could be very significant, and they get significant rather quickly. So it's akin to a hurricane knocking out a number of buildings, and it's a loss that hits very impactfully, very quickly. The mass vulnerability scenario is almost more like an asbestos situation. It's something that even when the vulnerability is discovered, it takes a long time until attacks start happening. Those attacks spread out over a long period of time. It takes companies time to discover those attacks even happened. And things like the lawsuits that may arise out of these large data breaches, the actual loss payments to the insurers can take years to pan out. So the same strategies that apply to protect yourself as an insurance company from a tail risk of a service provider interruption, like a cloud service provider, won't necessarily work the same way with a mass vulnerability event.
So
software companies actually have these patches. Usually they come up with patches which kind of takes care of the issues, the vulnerabilities that they have. So, as Scott said, the impact of a cloud failure is immediate and probably big, but with the software, it's gradual and has a tail in it.
right, so you described it almost as an asbestos.
Yeah.
But if that's an asbestos, what would be a tsunami?
I mean, again, I would say similar to be the cloud service provider. It's something that happens quickly, everybody knows that it happened. It's an industry event, and then everyone's cleaning up the mess together over the weeks after the event occurred.
Now, your stress test seems to show the possibility of significant losses. How bad for even some insolvency?
Yeah, so the losses were very significant. In terms of the percentages, I think we were some insurers were able to model loss severity in excess of their total policyholder surplus. Of course, we really focused our study on the top 20 writers of cyber liability coverage, projecting market trends of the recent past with 30% growth. So we're looking at very significant premium portfolios of cyber liability coverage. But we were able to find handfuls of carriers who could foreseeably see losses in excess of their total policyholder surplus. Of course, that's at the 1 in 200 severity level. So as a potential risk that might affect their book, it's not at the same PML level that things like a hurricane might be. But these are the sorts of things that carriers need to have on their radar and be preparing for today, which is why we spent so much time in the report focusing on the enterprise risk management philosophies and thought processes that carriers can start embedding into their business practices so that when we get to this market state that's very foreseeable in the near future, they'll be ready for it.
Probably at the risk of repeating what Scott said, what we did was that we took the losses for 150 and 1 in 100, and 200. For each 200, and for each of the companies that we had, we looked at the PML that these companies had in terms of NatCat, understanding that under the PML, these companies maintain the current ratings that they have, and since we look at the losses under the two events were lower than the PMLs that we used for the current rating levels, we decided to check those losses against the increase and the level of surplus that they had in 2022. Majority of the companies were well below 1 to 5%. There were a handful of companies that they exceeded, anywhere from 10 to 100% of their surplus in terms of gross losses. And again, I emphasize the gross losses because we still, we are not really able at this time to take into account reinsurance or the impact of the silent cyber.
Fred, any idea how well covered insurers are for their own cyber losses?
Well, as far as our rated entities are concerned, we go through a process with them on an annual basis regularly. We provide them with a questionnaire, which has basically 2 sections in it, and a set of 15, 20 questions on the way how they're protecting themselves. Whether or not they've been hacked, whether or not they have a response plan, whether they do penetration testings, and how much investments they've made during the past 3 years, how much they're planning to do during the next several years. So, we get those information, and then during the face-to-face meetings that we have with the companies, we'll have a good discussion on, how they protect themselves. And I think, we should be able to, we are comfortable to say that at least with regard to the companies that we rate, we are comfortable with the way they're protecting themselves, recognizing, of course, that cyber is a menace. It's, it cannot be predicted. So,
Scott, do you have a sense of how well reinsured insurers are for their cyber underwriting losses?
There have been some markets, so as Fred said, we didn't include any impacts of reinsurance on the gross loss estimates that are provided in the report. Anecdotally, I think we have a sense that there are a number of quota share treaties that are available. So a typical arrangement would be to share half of the risk, and then you'd share less than half of the premium, less the ceding commission for the transaction. But in essence, if a carrier had a 50-50 quota share, they could expect their loss to be half of what's been modeled. So the reinsurance market is an important aspect in the solvency and really sustainability of the cyber marketplace to be able to sustain these cyber storms and come through the other side. And I think we've seen some public reporting around the size of that market. So I think we can say with some degree of certainty that it's sizable. It's sizable enough to have a significant impact. It would drastically affect the numbers presented in this report if we were to include the reinsurance component of those losses.
Yeah, I think that's where the reinsurance partnership is very important, and also the nascent nature of the cyber risk, the newness of the cyber risk actually plays itself as well, because if there was an insurer trying to enter an established line of business, like let's say D&O or homeowners, they would typically retain very less risk and cede a lot of it to reinsurers, because reinsurers have the expertise to come and help them underwrite the risk. Sure. Because they are taking on a lot of their risk. But with cyber, it's new to everybody. It's new to the clients, it's new to the insurers, it's new to reinsurers. So I think there's more of an equal partnership in terms of insurance and reinsurance as opposed to other mature, steady state risks, I would say.
Fred, what's the possible rating impact of a cyber catastrophe?
Well, again, going through this exercise, with the exception of those few from whom we don't have a specific information, it's nothing big right now. I mean, there is not concern about rating impact. But having said that, you know, when we discuss this with the companies, we look at how they're managing their cyber exposure, what underwriting practices they use, what kind of pricing methods and reserving methods that they use. We look at those within the ERM framework of each individual company, and there we can score the company accordingly if we are comfortable with the way they're able to measure the aggregation or the exposure that they have. For the most part, from what we're hearing, I think companies are taking this very methodically. They are not going crazy. I mean, the market is full of capacity for cyber, but they're not, rushing to get anything. I mean, they're doing it, as I said, methodically and very measured step in terms of writing this risk.
Sridhar, information on third-party suppliers and accumulations remains limited. Do you think that will change?
It should change. I mean, taking a step back, I mean, even information on first-party, a company's own cyber posture, I think the exposure data measurement is still pretty new. How do I measure my cyber exposure for an insurer or for a company? I think there are standards like the NIS, the National Institute of Standards and Technology, NIST, has come up with some recommendations like how do you measure the amount of recovery redundancy you have, or what is the shortest attack path? Can I measure the number of compromised hosts, so on and so forth? So like the CVS framework. So I think there's some exposure measurement techniques that the for cyber risk, and with new regulations that is coming. I mean, there's the model law for the New York State for the NAIC and that New York has adopted. I think with all these regulations coming, I think this is going to become a much more systematic process that will require involvement with board, etc. So the first party itself is evolving. Now take it one step further, and then you need to do the same kind of exposure assessment to your vendors and suppliers and your outsourced systems, etc. It just becomes a very complicated exercise, which in our view is still in very early days of infancy, and that's where we could see a loss of a huge magnitude coming on the contingent business interruption. Even for a mature risk like what we would call catastrophe, the floods in Thailand or recently Hurricane Maria in Puerto Rico, they caused a lot of contingent business interruption claims. So if well-established, or seemingly well-understood risks can cause these kind of CBI claims, then I would only think that this would be amplified for an event like cyber, especially because of its interconnectedness, right, Scott?
Yeah, absolutely.
All right. Fred, what impact will the NAIC's insurance data security model law have on U.S. insurers and insureds?
Actually, I think regulations are great for this, for cyber. New York State came up with the law last year. It became effective again, almost a year ago. GDRP became effective on May 28th. The model law is being picked up by other states as well. So I think companies have still a long way to go to make themselves, protected against cyber attacks. They're limping towards that goal themselves. So if you put the regulation on top of this with a specific time frame, they're going to be running towards that goal, which is a good thing for the companies. That's how I see the impact of regulations on the whole cyber and resiliency of our companies too.
Yeah, especially with GDPR. I mean, there's actual monetary fines involved. I mean,
Right.
it could be like 20 million euros or X percentage. I think it's 4% of a company's revenue. So when you actually have financial penalties and on top of regulatory restrictions, then I think companies start taking these their cybersecurity posture a lot more seriously and make sure that they protect the PII is the personal identifiable information of their clients and the other vendors, and make sure that their cyber posture is well protected. And same thing with, I mean, the NAIC has taken a much more top board level approach where it involves annual testing and much more involvement from the management. And I think those regulations will also evolve as we speak and become more mature.
Mm-hmm. Yeah, to build on all of that, the GDPR really, in the United States cyber liability market, was really the catalyst for it was these data breach notification laws that came online in Massachusetts and California and have swept across all the U.S. states, I believe. There might be a few laggards. But that really drives a visibility to a problem that would once have been swept under the rug and just not addressed at all. And GDPR is really going to bring that same visibility and the potential costs to the European market, which is a significant opportunity for carriers to help support, as part of a multi-pronged risk management strategy, companies that are domiciled or have significant operations in the European Union, and to better address this new risk that they're going to have to face.
I would be remiss, John, if I didn't mention the recent GDPR report that AM Best put, which talks well about the implications of GDPR on the insurance industry. So I would urge all the viewers to take a look at that as well.
Well, let's expand upon that a little bit. What impact will GDPR have on European and global insurers and insureds?
Well, based on that report, I think we are comfortable that at least around 70% of the companies that we rate in Europe are in compliance or have gotten there in terms of compliance with GDPR, which is higher than what other surveys have shown, which is about 60% of readiness for that compliance. So we're proud that our rated entities have been following and have been responsive to the regulations, and they're almost there.
All right. Well, this has been a very interesting discussion today, gentlemen. I'd like to thank you all. But before we close things out, I'd like to get each of your thoughts on what you think the big takeaway is of today's webinar, what you would like registrants to remember. And Scott Hamusfar, why don't we start with you? What do you see as the big takeaway here today?
Yeah, absolutely. I think cyber is an endemic risk that's going to be increasingly important to carriers, whether or not they decide to take on the opportunity to underwrite this growing cyber liability coverage line. I think the key takeaways we think that are important are that the importance of real exposure data to really understand the idiosyncratic and, really more importantly, that systemic risk component that's part of the nature of cyber liability, and the levels of expertise that are necessary to embed the lessons coming from this data. It's often very complex. It's coming in real time. These are trends that are affecting the P&C insurance industry for how do you take in data like that and really operationalize the insights that are coming out of it to steer a portfolio towards a sustainably profitable model. And so I think just the ability to collect that data, to think about the kinds of expertise you'd want to embed in-house in order to be able to operationalize that data, and to think about that as a growth opportunity, as a challenge, but it's a growth opportunity for the industry.
Thanks, Scott. Sridhar Manian, what do you see as the big takeaway here?
Yeah, from an AM Best perspective, we've always emphasized stress testing as a component of our rating process. We were one of the first to introduce the catastrophe stress tests. We have a terrorism stress test. We collect a lot of data on cyber. But I think along that continuum, I think engaging for insurers to understand their true cyber exposure and the impact of a cyber stress test on capital, I think would be a useful exercise in order to assess how ready are they in order to insure cyber risk, and is it a growth opportunity, and how careful should they be in terms of prudent cyber risk management.
Thanks, Sridhar. Fred Islami, you get the last word today.
Yeah, I'm very proud of this report. I think a lot of investment resources, went through this. It was a report that was needed by the industry. As I mentioned at the beginning, all the existing reports that are available was talking about the overall and economic losses, but we took the extra step and actually looked at individual insurance companies and looked at their individual potential exposures in 2022. What I would love to see from our companies is that, after they read this report, hopefully they have interest to find out who those 3-4 companies are who may have shown weakness in their approach. And we would be more than happy to sit down with them and go over their profiles and discuss whatever measures that they're planning to take.
Gentlemen, thank you all so much for an outstanding presentation here today. The report can be found online at ambest.com. And for AM Best TV, I'm John Weber.